My name is Fred Strauss, and I'm the Portfolio Manager for the Watershed International Share Portfolio. The Watershed International Share Portfolio consists of high-quality global businesses whose shares are listed on major global stock exchanges. The portfolio objective is to deliver superior returns by investing in businesses that have a market leadership position and a proven and sustainable competitive edge. Although the portfolio is not, or the portfolio composition rather, is not index-driven, the portfolio aims to outperform the MSCI World Index, excluding Australia, over a rolling 3-year period by at least 2 to 3% per annum. Being an equities portfolio, the portfolio is really suitable for investors who seek long-term capital growth and portfolio diversification and have an investment horizon of at least 5 years. If we have a look at fund performance for the 12 months ended June, the portfolio really performed very well by returning 7.8% if we measure it in US dollars, or 10.8% for the year if we measure it in Australian dollars. If we compare that with the MSCI World Index, excluding Australia, that fell by more than 2% in both US dollars and Australian dollars terms. The portfolio therefore outperforms its benchmark by more than 10% in both US dollars and Australian dollars. That outperformance was really driven by the portfolio being positioned to benefit from the US economic recovery and from developments in technology such as the cloud, data analytics, artificial intelligence, and the Internet of Things. Since inception, at the beginning of 2010, the portfolio has outperformed the benchmark by 7% per annum in both US dollar and Australian dollar terms. As far as stock-specific performance goes, all stocks in the portfolio performed well for the year ended June, except for the 2 banking stocks. The clear outperformers were Amazon, Alphabet or Google, Johnson & Johnson, Costco, General Electric, Microsoft and 3M. As far as the banking stocks are concerned, banks really struggle to grow earnings in a declining interest rate environment as their net interest margins come under pressure. And the market during 2016 lowered its expectation of the pace of interest rate hikes by the US Federal Reserve, and prices then on all banking stocks really fell accordingly. As a consequence, the 2 banking stocks in the portfolio, namely Wells Fargo and US Bancorp, underperformed. If we turn to the outlook for the next 12 months or so, we remain very positive on the US economic recovery, and we expect an acceleration in wage growth to drive the second phase of that recovery in the US. As such, we do not really anticipate making major significant changes to the portfolio, as it's really well positioned to benefit from what's happening in the US. There's also a possibility of the Aussie dollar weakening against the US dollar over the medium term as the interest rate differential between Australia and the US narrows. So those currency changes may also contribute a bit to performance. Thank you very much for joining me for the update.